Welcome to the BD Daily Finance News Podcast. Daily insights on markets, economy, and investing. I'm your host.
And I'm your guest. It's December 2nd, 2025, and we've got a packed show today. Think of it as a financial hazard briefing, but with more laughs and hopefully fewer sirens.
Exactly. We're covering three major stories: a seismic shift at Nvidia that's hitting supply chains, the emerging frontrunner for the next Fed chair, and a stark warning from the Bank of England.
Let's start with the silicon drama. Nvidia, the king of AI chips, is making a huge strategic shift. The result? Shortages of other types of chips that also go into consumer electronics.
Right. It's like if a famous bakery decided to only make wedding cake tiers. Suddenly, there's a shortage of bread and bagels because all the ovens and bakers are tied up on these elaborate, expensive cakes.
I love that analogy. So for normal people, this could mean your next smartphone, laptop, or gaming console gets more expensive or is harder to find. The AI infrastructure build-out is cannibalizing the supply for our gadgets.
Precisely. It's a classic case of capital allocation. Investors are pouring money into AI, so that's where the resources go. For consumers, the actionable insight might be, if you're planning a major tech purchase, consider pulling the trigger sooner rather than later.
Speaking of major decisions, let's talk about the world's most important part-time job, Federal Reserve Chair. A regime change is looming, and one candidate is emerging as the frontrunner.
This is huge. The Fed chair controls the lever for interest rates, which influences everything from your mortgage rate to the yield on your savings account. It's like choosing the pilot for the entire economy's airplane.
And we don't even get to vote. The market's betting on whether the next pilot will be hawkish, wanting to keep rates higher to fight inflation, or dovish, aiming to cut rates to stimulate growth. This uncertainty alone can cause market jitters.
For our listeners, the key is to not panic, but to pay attention. The direction of rates impacts debt strategy. If you have variable rate debt, a hawkish chair might make locking in a fixed rate more attractive.
Now for a warning from across the pond. The Bank of England just flagged that the multi-trillion-dollar AI boom financed by debt could unravel. They used the phrase materially stretched valuations.
That's central banker speak for this party might be getting too wild. Imagine everyone at the party bought their fancy clothes and drinks using a shared credit card that nobody wants to pay off later.
It's a cautionary tale for investors. When excitement about a technology like AI leads companies to borrow heavily to build infrastructure, it creates fragility. If growth doesn't meet expectations, the debt burden can trigger a nasty downturn.
The takeaway? Diversification remains crucial. Don't let the AI hype cause you to overload your portfolio with companies that have weak balance sheets, no matter how sexy their technology sounds.
A couple of quick hits to round out the picture. Eurozone inflation edged up to 2.2% in November. That's above the target, backing the ECB's decision to hold rates steady for now.
And in a brighter note, MongoDB stock jumped 15% after beating earnings estimates. It shows strong demand for their cloud database services, a key piece of the modern tech stack.
So to recap, watch tech supply chains, watch the Fed, and watch corporate debt levels in the AI space. It's a lot of watching.
That's why we're here. For more daily insights that connect the dots between headlines and your financial life, make sure to subscribe. Thanks for listening to the BD Daily Finance News Podcast.
See you tomorrow.